G'day Internet, Max right here, and sorry, been away for a week or so. Actually, I was moving house, and so it was quite refreshing. Actually, I just didn't have the computer hooked up for well over a week. So I am back. If you're happy to see me, go ahead, do me a favor, hit that like button, and we will get to it. So today we're going to hear from Michael Saylor, but before we do that, I guess, you know what we should do? We should take a look at the price here and see what we can see. We're going to answer the question. Michael Saylor is going to talk about, should you use leverage to purchase your cryptocurrency or other financial assets right now? We're going to do a deep dive into that topic with Michael Saylor in just a minute. But let's go ahead and check out some Bitcoin price action. And we see we are at all-time highs right up here. Isn't it funny how that just seems like a yawn? We're at all-time highs. And I don't know if, to me, that's like boring. Like if it's not a parabolic move, I just don't care. Like I wake up and Bitcoin's up 3% to a new all-time high. I'm just like, yeah, whatever. It's like, has it doubled yet? That's the world of crypto though, right? So we're seeing ourselves at all-time high. Let me know. So I tell you this so many times, but these vertical blue lines represent the last Friday of the month. Well, the fourth Friday and the last Friday of the month, very often they're the same Friday. Sometimes they're separate Fridays. And I always say the price does drop down during that period, and it's the middle of the month where you see the highs. So here we see it was a low. This one wasn't too bad. But down here we had lows and lows. So just easy little arbitrage to make there. I didn't actually play that, but if you do, let me know. You guys should have made so much money with that if you're into it. I'm just busy doing other things. Now, right here, we're approaching the middle of the month, but not quite there yet. So I would expect a little bit more upside to the Bitcoin price. Just FYI, just based on that very, very simple thing. But we're doing really well. Bitcoin dominance got kind of beat up the last week. Let's take a quick look at that. But we see it's rebounding. But this is important. It did drop below this trend line. And looks like my trend line's off a little bit here. Let's rebuild that. No, go away. Yep. Let's put that there. And you can see really all that's happening here. We broke through that trend. Now we're coming up and it looks like it's confirmed it as support. So this could mean the continuation of an altcoin run. Just FYI. That's what that looks like to me. But we'll have to pay attention to that as we kind of move forward here in the next few days. So just looks like the continuation of this little mini altcoin run. So we will see. We'll see how that plays out. All right, let's get back to Michael Saylor because this is a really, really important topic. I know you guys, a lot of people ask this question like, you're excited by crypto, you've got the picture, you know, you probably haven't been in it for a week or two. Like after you've been in crypto for a week or two, you're curious. There's potential here. There's something here. After 4, 5, 6, 7 months of consuming everything you found, you're like, oh my God, this is going to change the world. I need to be involved in this. If I could go back and be a seed investor in Facebook, would I? I got to just find every scrap, every penny I can, and stick it into crypto. Right? That's where a lot of you are, and it's a fun place to be. It's a good place to be, but obviously it comes with a lot of dangers. So let's Well, actually, we'll get to Michael Saylor here in just a second. I just want to, for very, very basically, what is leverage? Leverage multiplies your power, right? When my boy was 4 years old, we walked around the house. I introduced him to the concept of leverage. We walked around with a lever, and we lifted up furniture and beds and couches and things that he couldn't lift by himself, but he was able to do it with a lever, and he loved the lesson on what leverage is. Okay, so financial leverage basically means borrowing money. Because you have a certain amount of assets, let's say you have $100,000 you're thinking of investing, and do you go and get leverage, which means you can go and buy $1 million worth of crypto, even though you only have $100,000. It's multiplying your power. That's leverage. And what it means is you're borrowing money to buy crypto. So very, very important concepts. However, it comes with extreme danger in the world of crypto because you can get wiped out, meaning Bitcoin goes down 50% all the time. So if you, let's say you just use 2-to-1 leverage. You've got $100,000, but you buy $200,000 worth of Bitcoin, and then the price gets smashed 50%. Well, that doesn't mean you lose 50%. You lose 100% of your money. All of your $100,000 is gone because you only had $100,000 to lose. You use that as collateral to borrow another $100,000. So you bought $200,000 worth of Bitcoin. Then that $200,000 Bitcoin got chopped in half. So there's only $100,000 of value there, which means you've lost $100,000 of value. But you only had $100,000 to lose to start with, and the exchange will liquidate you and you have nothing. So leverage comes with danger. Let's hear how Michael Saylor has played this game. We'll talk about what he's done at MicroStrategy in just a minute, and we'll talk about the concepts he's talking about right here.
Like, why would you own the other stuff? Well, look, it's okay to own a beach house. Buy the land around your house for privacy. Buy a piece of art. Buy beautiful jewelry. Buy a car. Buy a yacht. Buy a jet. Knock yourself out. If you buy the yacht and the jet, use debt. If you buy the house, use debt. Take your mortgage, 30 years, 2.2% interest. Why wouldn't you? Right? The money is losing 15% of its value a year. So you're actually getting a 12.5 to 15% arbitrage on the mortgage. Of course, load up on cheap fiat debt, buy and load up on high quality assets, buy assets that wealthy people are going to want to own in a decade that are scarce, right? Don't buy assets that I can make more of, that I can debase, right? That's why you don't invest in manufactured box cereal, right? It's not scarce, right? Even oil, silver, oil, commodities, natural gas. Don't invest in things like that for the long term. You can trade them, but what's the problem with like natural gas? Well, if there's a shortage, it goes up in price by a factor of 5, and some politician wants to put a price control on it because people need it. You see, so people are going to pass wage and price controls, what's the problem with real estate? Well, you can't evict your tenants because times are difficult. Well, when the times are really difficult, your property's not going to generate yield because a politician's going to tell you that somebody else's rights supersede your rights. What's the problem with owning gold? When the price goes up by a factor of 20, gold miners are going to produce more gold and people are going to melt down their gold jewelry. So the problem with commodities that can be produced is people will make more of it, or some politician's going to impair it. What can't they impair? Pure digital property, because it's in cyberspace, it's outside of their jurisdiction, you can move it at the speed of light. And if you own that 1,000-room hotel in Austin, Texas, don't you really want to put the hotel in the place with the richest people that need it the most at any given minute? Good luck with something that has physicality. But if it's an energy hotel, you can put it. Yeah, like guy in Beijing needs Bitcoin. Rich woman in Moscow needs Bitcoin. Everybody needs Bitcoin. For the next 100 years, every rich person on earth is going to need Bitcoin.
All right. So there's some really, really powerful lessons in there. Let's go through them. So we'll try and attack the question. Should you load up on debt to purchase Bitcoin? And the answer is it depends. Depends on what kind of debt, depends on the cash flow you have. So let's unpack all of this. He made the claim. He said, listen, if you're going to buy the house or the jet or the yacht, borrow the money to do it because it's losing 15% of its value every year. So what's he saying here? He's saying if you go, he's expecting high inflation. So that's a critical thing to understand here. In the long term, I think every sensible person is expecting high inflation. However, there can be a short-term deflationary event, i.e. a stock market crash, a cryptocurrency crash, a real estate market crash. The response will be an enormous amount of money printing, and then inflation will resume again. So that is important to understand. When we're playing with the topics we're talking about today, you have to understand the scenarios that can play out. And this is like really easy. There's 3 scenarios that can always play out. The markets can go up, markets can go down, markets can go sideways. However, there's things happening now which tell us 5, 10, 15, 20 years from now, we know what's going to happen. We know we're going to go into there'll be massive inflation. Over 10, 15, 20 years, we have an increased certainty that there will be massive inflation. Why? Because the system is broken. They have absolutely destroyed capitalism. The government has grown like a cancer in every country in the world. It is a gargantuan mammoth beast that eats itself and everybody else around it, making all of its citizens poor. And they do that by the mechanism of inflation. They print money and they steal the purchasing power of any dollars, any savings, any assets that you have. Taxation is just the small portion of how much they steal from you. Inflation is the bigger one at this point. So, okay, we know long term that's what's going to happen. How do you play that? Well, the answer is you get debt. So why does that work? Why does this play work? Well, it's very simple. Let's just say, we'll forget that black swan event where it deflates for just a little bit. Like we'll say there's a crash and the real estate market gets smashed and blah, blah, blah. We'll just jump from now to 15 years in the future. And your house that was worth $1 million is now worth $20 million. right? So you've got this house. You bought it for $1 million. Let's say you've got an $800,000 mortgage on it. You hold it for 15 years. Your house is now worth $20 million. What's your debt worth? Well, let's say if you had an interest-only debt, your mortgage is still worth $800,000, right? So the value of the house skyrocketed. The value of the debt was trapped in 2021 dollars, right? The value of the house 20 years from now is in 2041 dollars, which means it's worth $20 million, yes? And the value of your debt is trapped in historical money. So that's with a future projection. Just we want to help understand that, just to wrap your mind around it. Let's do it with a past projection. How much did your grandmother buy her house for? She probably bought it for about $3,000. Imagine she put down a $1,000 deposit, had a $2,000 mortgage on it. Today the house is worth $400,000. All right? The debt gets inflated away. The debt becomes irrelevant because while inflation is eating all of your dollars, it's also eating all of your debt. Right? Eventually, 20, 30, 40 years from now, or maybe 5 or 10 years from now, who knows how much inflation we're going to have. If you go buy a piece of real estate as an investment property, one tenant's 1 month's rent might pay off the entire mortgage. Why? Because we went into high inflation. Rent went way up. The value of the property went way up. The debt didn't go up. All right? And all of a sudden, 20 years from now, one rent payment just pays off the debt, the whole mortgage, not the repayment, the whole mortgage. So that's what Saylor's alluding to here. He wants to use debt because the debt gets eroded away, inflated away. However, the value of the assets which you purchase with that debt goes up. So he's talking about assets. Let's jump in here with a little bit of a Robert Kiyosaki definition of assets. Robert Kiyosaki suggests that an asset is something that you own that puts money in your pocket. Right? It is not something that you own that you can sell later. This is an interesting concept, and it's a powerful one. It's one that I subscribe to, and Bitcoin kind of broke this model a little bit because Bitcoin is the best performing asset. But does it put money in my pocket? Well, actually, now it can for the first time. Like in the last year or so, you can actually get a yield on your Bitcoin. Prior to this, you haven't been able to do so. But now the reason why that definition is important is with regards to this specific topic of debt. Right? So your debt, if you have debt, like let's just take the house example. Let's say you go and get, and this is the example that Saylor, with certain assets, you can get different kinds of debt, and that changes everything. So pay attention to this next part. When you go for a loan on your house, you can get like fixed rate 30-year loans, right? That eliminates an enormous amount of risk that can happen in the future. So let's skip the house, let's go with an investment property. And we'll see how this plays out. You buy an investment property, right? And you get 30-year debt, fixed interest. And when you buy it, the rent is paying off the mortgage. Well, given there might be short little terms of pullbacks, like the real estate market might get hit hard. Generally, when the real estate market gets hit, rent market doesn't get hit very hard, by the way. So the rent continues to come in, and you can service this debt. Right? And especially if you have a residential loan, this is not true for a commercial loan. If you have a residential loan, you can't get revalued, right? If let's say that real estate market gets hit and you get the real estate, your house is, the investment property that you bought is worth 20% less, 30% less, 40% less, right? But it was just a single family residence, or maybe it's a duplex or a triplex, or it's up to a fourplex in the United States. You can get residential loans on up to a fourplex in the US. They can't come and revalue that. The banks can't come to you and say, hey, we've revalued your loan, your property, and it's worth half, which means you're underwater. We're calling in the debt. Commercial property, if you have a commercial loan, it's the type of loan that's most important. A commercial loan, they can come and revalue you and say, we want you to put more money in. And they can call in the loan and boom, you can get called in. Residential loans, they cannot do that, right? And like I said, you can buy up to a fourplex with a residential loan. A very, very, very important distinction, right? Because remember, we know where it's going. We know where we're going to be 15 years time from now. But we've got to navigate the tricky waters between here and there. And the tricky waters between here and there may include a 30-40% collapse in the real estate market, a 30-40% in the stock market, 50% collapse in the stock market, an 80% collapse in the Bitcoin market. We have to be able to navigate all of those things without getting wrecked. So the type of debt becomes critically important. So debt on your house, you can get 30-year fixed. So you have no interest rate threat of interest rates going up. You have no threat of being called in because you're upside down. None of that stuff. All of those things are eliminated. So if you can acquire that kind of debt, that is a very, very good debt to acquire if you can put it into something that is either appreciating in value or creating cash flow. That's a very, very good type of debt. Let's go look and talk about another type of debt. When I, at the top of the show, when I said, hey, should you buy crypto with leverage? The most obvious thing that you probably thought of is you go into Kraken. I'm not sure if Coinbase does it, or you go to Binance or KuCoin or wherever you go. You say, you deposit $100,000 and you say, hey, I'm going to buy $200,000, $300,000, $500,000 worth of Bitcoin. I'm going to use leverage on exchange. Well, let's take a look at that kind of debt. So I think the interest rate on it is trivial, if anything. I'm not sure if they even charge interest on those loans, depending on the exchange. So interest is trivial. We'll say that's not really a big risk. But can they call your loan in? The answer is absolutely. See, the real estate debt, the residential real estate, they cannot revalue your property and say you're underwater and liquidate you. Commercial loans in real estate, they can. Crypto exchange, they'll send you an email after it happens. Hey guys, the price of Bitcoin just collapsed. You got liquidated. Sorry, we've taken all your money, right? You got liquidated. You are out, because they can revalue the asset, and literally minute by minute, the asset is getting revalued. And if at any point between now and 15 years time from now, the price got smashed down and you did not have enough liquidity in there to cover, capital in there to cover, you're going to get liquidated and you're going to lose it all. They will call in your debt, liquidate everything, and you lose everything. So the question, do you want to take out leverage to buy cryptocurrency, now becomes a very important question. What kind of leverage? So Michael Saylor here did an absolutely phenomenal thing, brilliant thing. I think it'll go down as one of the greatest trades in history. He was in the fortunate position of having a Fortune 500 company listed on the exchange, and they can go and get corporate bonds. They can sell corporate bonds. There's a whole liquid market for it, and people are just buying it there to wait it up. He sold a corporate bond. I believe it had a 5-year term. The term of that bond means you cannot call in that debt. Right? You got to wait your 5 years to get your money back. I think you get a yield between now and then, but you cannot call in that debt. Right? So like with the house, it's like 30 years they can't call in the debt. On the exchange, minute by minute they can call in the debt. Right? On his money, he's got 5 years. He's got a 5-year grace where they cannot call in the debt. The interest rate that he got on that corporate bond, thank you to the Fed interfering with the bond market, he got 0.5%, right? So he's got this loan. No one can call him on it for 5 years. He has to pay 0.5% for 5 years. What did he do? The smartest thing you could possibly do, he went and stuck it all in Bitcoin. Here's an asset that's been around for 12 years. Never in the history of its life, at any second, has it had a price lower than 4 years ago. Right? And he got a 5-year note. What are the chances of him getting caught with his pants down, and when that 5-year note comes due, that the value of the Bitcoin he bought is actually less than the bond he holds on it? I would argue very, very minimally. Right? So it's a very, very minimal risk. It is a no-brainer risk. Well, here's the thing. You can do the same thing, but with your mortgage. Now, some people are already maxed out on their mortgages, and that's the case, so be it. Some people have their house paid off, or at least paid down, and they have access to line of credit, more capital. Some people have businesses, business loans. Now, the terms of the loan are unbelievably important. Line of credit, typically, they can just call that in whenever they want. Say, hey, the bank's no longer offering this. You need to go and get finance somewhere else and pay me back, like pronto, right now. We'll give you 3 months, right? Don't do it with lines of credit if those are the terms. Don't do it with commercial real estate. You got a commercial property fully paid off. You can go and get a loan against it and buy crypto. Problem is, You don't know that loan can get called in. Residential real estate, you got a holiday house paid off, you got your primary house paid off, you got a few things paid off. Then all of a sudden, now you can go and take a 30-year loan, 2-3% interest, something like that. No one can force you. And what are the chances of governments around the world not printing more money between now and 30 years from now? I would argue close to zero. Now you could argue things like competition, other cryptocurrencies could dethrone Bitcoin, something like that. So it's not a risk-free trade by a long stretch, but it's a pretty darn good one. Now, I did say something else there. I mentioned your primary residence. That is all of a sudden now a much bigger risk. Like, you don't want to end up homeless, right? So I'm not necessarily recommending that, but certain people and certain risk appetites might like that. But the thing that I wanted to draw attention to is the type of loan. The type of loan makes leverage very, very simple, relatively safe, I would argue. Leveraging on the exchanges for a long-term hold, that's very, very risky. Very, very risky, because you can get liquidated very, very quickly. And you don't have that longevity there. So I hope this helps people understand some of the very tricky concepts with regards to leverage. Should you use leverage to buy crypto? Is not as simple as yes or no. What are the terms of your finance? Fixed interest, long term, cannot be called in during the term. Very, very powerful. That becomes a much, much safer option than buying with leverage on the exchange. Two very, very different conversations as to whether or not they are safe or not. So depending on your risk appetite, depending on your financial position, depending on where you're at, now that's the questions for you guys to answer. Remember, I'm not your financial advisor. If you like these concepts, if you like me explaining these concepts to me, do me a favor. Hit me up in the, hit the like button, subscribe. We do lots of education on this channel. And do me a favor, let me know in the comments below, do you have any leverage in the crypto markets? If so, what type of leverage? If it's a bad type of leverage that I've talked about, can you do something to restructure it to a better kind of leverage that would help you be more safe? Let me know in the comments below if you think it's a good idea or not. Take care, guys, and I will see you soon.